The bears got it wrong that we're going to have an AI bubble, that tech stocks were going to go straight down, and they tried their hardest to compare it to 99 2000. The bears will be right at some point. Here's what I'm going to say, David. We'll have the next big cyclical bull market, which will be the last cyclical bull market of our 25-year secular bull market call. Last year was an anomaly. We had an exogenous event called tariffs that quote unquote freaked everybody out. The end of the world. The end of the world trade you can't collect on. So have faith. When everybody gets nervous and sells, it's going to drive the V to come back, and that's why U.S. assets outperform.
Brian Belski joins us once more. He's a CEO and CIO of his own firm now, Humilis Investment Strategies, which he started back in October last year. This follows his 13-year stint as CIO at BMO Capital Markets. Brian's a 35-year veteran on Wall Street. So we're going to get his outlook on the U.S. equities markets and which sectors he favors. This episode is brought to you by Kalshi. It's a fully regulated platform that lets you trade on real-world events from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here. New users will get $10 on their $100 deposit. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. Brian, welcome back to the show. Good to see you as always.
Thank you so much, David. We really appreciate the support.
The outlook for the markets is what we're going to be focusing on today. You're still bullish on the S&P 500. I believe you've got a target that's well above current levels. Before we get to that, let me just show you a chart. I don't want to reveal, well, I guess the title's in there. But I wanted to play this game where I don't really show what the title is, and then you kind of just like look at it and we talk about it. But anyway, this is the price of silver. If this were a price of any stock, and we're not here to talk about commodities in particular, but if this were the price of any particular stock, whether it be large cap or silver or small cap, it doesn't matter. And it goes straight up in a straight line. Basically, it's gone up from $30 to 90, so 3x'd in the last 6 months. What would you say to yourself? What kind of questions would you be asking yourself on what to do with this particular security?
Well, we'll never begrudge when asset prices go higher. So let's accept that. Number one, we're not going to be Johnny Raincloud in terms of worrying that stock prices or an asset price goes up too much. I think what's interesting on this chart is when you see where the bottom was in 2025. The bottom in 2025 also coincided with that prior top in 2024. The chart for gold looks very similar. If you kind of go back, I'm willing to bet that's probably April of 2025 when many investors were worried about the wherewithal of the United States. There was a lot of tariff talk and the fear trade got going. And so I think a lot of people moved to harder commodities. And then what you really see what's happened later in 2025, David, is the momentum trade turned on full bore. And we're not going to begrudge momentum. We have been long-term believers and holders of technology stocks. I think the difference with respect to what we've been saying and seeing in terms of these types of parabolic moves in technology stocks, especially circling around AI, let's say it, there's a lot more fundamental, I call it chutzpah, quite frankly, to some of these technology stocks from silver and gold. Now, again, on the silver trade, I think it's fantastic. It's amazing. Your question is, Brian, what do you tell investors right now? And I always tell investors right now, especially given when you see charts and price action like that, is proceed with caution because we've had this triple move now. And I think investors now are going to expect the same type of returns over the next year or so. And we, quite frankly, from a fundamental perspective at Humilis Investment Strategies, don't believe we're going to see that type of move in some of these commodities over the next 12 months.
Okay, I bring this up because if you were to zoom out on the S&P 500, obviously the move is not this dramatic. The parabolic line we saw in silver is not really applicable here, but it's basically been a straight line ever since 2009 with a few big dips along the way. So to your outlook about 7,300 to 7,500, why are you not more cautious in the stock market than you would be on something like silver, which I just pulled up as an example?
Well, again, let's go back to fundamentals. If you take a look at the fundamental construct of the United States stock market, especially since we made our initial call for a 25-year secular bull market in print in the published medium in 2010, we came out with our call about a bull market in 2009, but then again, segued to 2010, the bull market in terms of being secular. In this secular bull market since 2009, we've had several cyclical bears and cyclical bulls. During these periods, during the cyclical bears, the stock market was able to take a pause, refresh, and regroup on a price perspective. On a fundamental perspective, when you take a look at things like valuation, earnings, cash flow, book value, dividends, we continue to believe that the United States stock market is in really good shape. Now let's go back and talk about these commodities. Are they in the same shape with respect to demand and supply and cash flow and what they're doing with the companies, or is this just a commodity? So it's a little bit like apples to oranges, but in terms of just price to price, we think the fundamental construct of the underpinnings of the equity market are much more timely and much more positive than the commodity market. Now, why are we not more bearish? Why would we need to be bearish? There's enough bears out there that are worried about an AI bubble or that the market's gone up too much. And most of these people, David, as you and I talked about before, they missed it. They missed the initial first half of this big secular bull market. They've been playing it since 23, really 24. And so they're kind of late to the party. So we do think that the big secular bull is well and alive. We think this fourth year of the bull market actually is going to be more historically like usually the third year of a bull market. Third year of the bull market is not as strong as the other years of the bull market. Last year was an anomaly. We had an exogenous event called tariffs that quote unquote freaked everybody out and made really drastic asset changes in equities.
Well, you've actually made the point to me before that geopolitical risks are just short-term noise. Case in point, tariffs, Liberation Day, April 2nd, 2025 last year. Yes, we did get a major correction immediately after the announcement, but we also got a major bounce back. And looking back, it was literally just noise. What about now? The whole world's talking about annexation. No one knows if this country's going to remain sovereign by next week. And yet the S&P is ripping higher. I mean, we are down today on some tech earnings news, but overall, we're nearing towards 7,000 points. So what do you make of geopolitical tensions right now?
I think I think they're overplayed. I think you're showing your emotion about annexation. You're showing, and just like, too many Canadian investors left in April last year, they didn't come back. Now, they were very blessed and fortunate that were Canadian centric investors, because Canada on an absolute performance using a local currency at its best absolute and relative performance relative to the S&P 500 since 1990. So congratulations, that's fantastic. But from a non-diversified index, which Canada is, and the majority of Canadian investors actually have to own a little bit of Europe or a little bit of emerging markets, or used to be a little bit of the US. A lot of them left. And I think that's risky when you base your decisions on politics and personal feelings with respect to those politics. In terms of your annexation, that's just blowhard type talk that let's just deal with what we can deal with. And just like in life, you always deal with what you can deal with. And here's how you deal with what you can deal with. Buy really good companies, which there's a ton in Canada and there's a ton in the United States. Turn off all the noise and just continue to stick with your process and discipline.
All right, let's talk about monetary policy now. There's this feud going on between Trump and Powell that's been made more apparent since Powell released a video of him saying basically that the Department of Justice issued a subpoena only because Powell refused to lower rates like Trump asked. Now, we don't know what's really going on behind the scenes. Maybe that's true, or maybe because the DOJ really just wanted to subpoena them because they didn't provide transparency on their budget. But anyway, who is going to be the next Fed chair, and more broadly, who or what is going to happen to the Fed monetary policy in 2026? This is from Kalshi. It's a platform that traders can go to place bets on certain predictions. So in this particular case, traders have placed a 44% chance on Kevin Warsh being nominated as the Fed chair. Kevin Hassett is a close second per this particular prediction market. So do you have a view on monetary policy for 2026 and whether or not this current feud between Trump and Powell is going to derail their dovishness?
Well, unfortunately, in this era of instant news, we tend to sensationalize things, and people need to take a step back and be a little bit more objective. If you go back in American history, just go back to the 1960s. There's a very famous meeting that took place between President Lyndon Baines Johnson with the head of the Fed in the mid 1960s. I can't remember his name. I'm sorry. If my good friend David Rosenberg was on with me, he'd know right away, of course. But he invited him out to his Texas ranch. He picked him up, literally picked him up physically, threw him up against the wall and said, we need you to cut interest rates. Then let's go to in the late 1960s, early 1970s with President Nixon. And again, the name of the Fed chairman is not coming to my mind, but President Nixon was very vocal in the press with respect to interest rates. And then let's go to 1984, after which Volcker cut interest rates along with President Reagan, and Speaker Tip O'Neill cut taxes in the United States. And then the economic recovery was on. Reagan was very, very aggressive in the press. So we love to pick on the president of the United States because of his behavior. We love to do this, but again, both sides are talking. You asked me the question in terms of monetary policy. We still think that rates are lower, given the fact that inflation is heading lower, period. We see that employment is still pretty sticky, but wages are kind of tipsy here. But we do think that the Fed's going to continue to cut rates irrespective of who's going to be in the chair. Our fundamental underpinnings are fundamental, David. Earnings growth, the economy looks good, valuations are not stretched, and we still think there's a tremendous amount of themes out there from a fundamental perspective that will drive U.S. and Canadian stocks higher.
What's going to drive stocks higher fundamentally? Is it going to be earnings, primarily EPS, or is it going to be valuations, expansion, PE?
In our report, we talk about the first 3 years of this new bull market that we were in print and started talking about in October of 2022. We said a new bull market, a new secular bull market has started. And this bull market has been all about multiple expansion. What we believe is going to occur both in the United States and Canada is the market's going to transition to more of an earnings-driven market. Based on our research, you go back and back test markets, whether or not they're driven by earnings or driven by multiple expansion. Earnings-driven markets are typically less exciting, meaning they're not as positive at the upside, but still positive nonetheless. So that's why we say positive is still positive. To have a 20+% move in equity prices in 2026 in both the U.S. and Canada, I think is going to be tougher with respect to, especially given the fact of how strong stocks were number one in Canada last year, but really how strong stocks, have been since the October 2022 lows.
Let's just take a look at what prediction markets are saying about the S&P. So S&P 500 closed by the end of 2026. So your view is somewhere between 7,300 to 7,500, which lies in the middle of the distribution of this particular trade. So you can see how people have been placing predictions. So the bulk is between 7,200 to 7,799. What would need to happen, Brian? And we're not going to talk about the tail risk mega bear forecast, but what would need to happen if, let's say, we're heading towards 8,000, which some people are still predicting 8% chance we're going to get 8,000, basically nearly a 20% chance, according to this prediction market, that we're going to go between 7,600 to 8,000 points by the end of the year, which would be a huge gain. What would need to happen for you to become even more bullish such that this prediction becomes realized?
Well, I'll tell you, first off, I kind of like not being in one of the tails. Usually I'm one of the tails, David, on the bullish side. But I think discretion is a better part of valor with respect to our market targets. We'd rather underpromise and overdeliver. We've been doing that in our career for 36 years now. But at the end of the day, you need to see 20 to 30% earnings growth, I think, to get up to those numbers that you're talking about, the 7,800 to 8,000, number one, and probably some sort of dramatic drop off in inflation. Remember, the Fed has a dual mandate: inflation and employment. So as long as employment, I think, kind of sticks around this 5% unemployment or below, and we see a really fast drop in inflation, which is really difficult. Inflation can go up like an elevator, but it's going down like a really, really, really slow escalator. And so that escalator has to increase and get pretty fast for, I think, these types of forecasts to occur.
Can you comment on your sector recommendation here and what you're
Sure.
overweight or perhaps underweight?
We're in Canada, we're overweight communication services, consumer discretionary, industrials, and utilities. Ooh, exciting. Much more cyclical. In the United States, we're overweight communication services, utilities, and financials.
Financials, yeah.
Financials, we think in the U.S. Are great plays not only for the value discipline, but I think we're going to get some very strong earnings growth. We have deregulation, and I think we have a lot of consolidation coming in financials. Remember, Canadians have a hard time understanding U.S. financials because there's 6 banks in Canada. In the U.S., we have 600 publicly traded banks and 4,000 banks overall in the United States. Too many. So with that capacity, I think we need to take out some capacity through some consolidation. Just
on Canada, are you still bullish overall on the TSX, or at least as bullish on the TSX overall as you would be on the S&P 500, given how heavy the TSX is weighted towards resources and oil? And you already talked about how gold and silver and these other commodities are overstretched.
We turned super bullish mid 2022 in Canada, which was excessively contrarian. Nobody believed us. And now, given the kind of move that we've seen in materials, especially last year, and remember, the banks had an amazing year in 2025, mostly because they over-reserved in 2023 and 2024. In fact, you and I have talked about when banks in Canada, when they typically over-reserve, they have massive outperformance for the 12 to 24 months that follow those periods. We've seen that now. And so when you have 2 of the big 3 sectors dominate like they did last year, I think it's going to be really difficult for that same type of performance in 2026. That's why we like the more cyclical areas in Canada, like industrials, like consumer discretionary. I think is an amazing sector in Canada in terms of buying select stocks there. We're being contrarian and buying communication services, a sector that everybody hates. But the cash flow is back and the dividends are still there. Then lastly, utilities are a play on AI infrastructure. And we think that that's going to be a very, very interesting and a theme that not a lot of Canadian investors are playing.
Finally, your report states that, look, nothing goes up in a straight line. I'm paraphrasing here, but corrections are imminent parts, or not imminent, but inevitable parts of the market cycle. Even though you're bullish, corrections could still happen. What would be the case for a correction this year?
Well, some sort of a surprise. The market, we saw the surprise in April. We could see a surprise based on a geopolitical event, which we believe will cause a massive V-shape type of recovery. Why V-shape? Because at the end of the day, no matter how much on a personal basis you don't like the United States sometimes, we are the best house in a really rocky neighborhood when the world gets rocky, and we still have the best companies in the world and the most consistency and fundamentals. And that's why we've seen not just the last 10 years, not just the last 20 years, but the last 50 years, when we see geopolitical events coming out of that, the United States stock market rapidly and massively outperform. So if we get some sort of a surprise, and I don't like I think you and I have talked about like black swan events through the years and all this stuff, the end of the world. The greatest thing about a black swan trade is, hey, Belski, how come you don't have the black swan strategy? The best line you can tell people is because you can never collect on the black swan strategy, right? Right. The end of the world. The end of the world trade you can't collect on. So have faith in what's faith in our business fundamentals, and the fundamental construct of the United States stock market is such that it's going to drive the V. When everybody gets nervous and sells, it's going to drive the V to come back, and that's why U.S. assets outperform.
Final question before I let you go. So, Brian, here you've got 2 figures showing the average length of bull markets in the United States, the S&P 500 in particular. And as you can see, the light blue bar where we're currently at, we're still at historic average, not yet. So there's still some more room to climb, so there's more to go in terms of the duration of this particular bull market. What have bears gotten wrong in the last 2 years, besides calling for a recession, which I guess technically didn't happen? But fundamentally, what was wrong with the bear thesis in the last 2 years?
Well,
in retrospect, of course, yeah.
At the end of the day, I think the bears are amazing. We need the bears. because we need those sellers. And bears are fantastic because they're really smart and they have all these great statistics. But 7.5 years out of 10, the stock market's up. So we would play those odds. I think the bears got it wrong that we're going to have an AI bubble, that tech stocks were going to go straight down, and they tried their hardest to compare it to 99 2000, which to us, we lived through 99 2000 as strategists, and we're investors back then too. This is what's going on with AI stocks had nothing to do with that. Then they pounded on the geopolitical trade in terms of President Trump and the tariffs. That didn't really work out either. And now the latest thing is talking about the long end of the curve and talking about interest rates and the Fed. I just think it's going to be really difficult. So the bears will be right at some point. Here's what I'm going to say, David. Markets will have a normal recession at some point. 2 down quarters of GDP. We haven't had a normal recession for a long, long time. COVID was not a normal recession. And so that we'll let the bears have their recession, and come into that, we'll have the next big cyclical bull market, which will be the last cyclical bull market of our 25-year secular bull market call.
Okay, we'll follow up closer to that period. Thank you so much, Brian. Where can we follow your work right now?
You can check us out at humilisinv.com. That's HUMILISINV.com. And there's a bunch of cool media clips in there. You can click and see our research. You can click and see where our portfolios are available in the US and Canada. Thank you for all your support. And we really appreciate the last decades in Canada with you.
Thanks, Brian. Don't forget to follow Brian and Humilis Investment Strategies, link down below. Don't forget to subscribe to this channel, and don't forget to use my code LIN, L-I-N, when you sign up to Kalshi, link down below, or scan the QR code here, and you'll get $10 on your first $100 deposit.